Well, welcome to the Mutual Fund Show. My name is Neeraj Shah. Over the next 25 minutes, we'll try and dissect some aspects of mutual funds. Today's show largely divided into 3 or 4 pieces, but largely around a centerpiece, which will talk about what happens if you, well, for lack of a better word, and trying to put it simplistically, churn portfolios too much. Are there costs that are get involved, and do your returns get impacted as a result of that? That's part one, because I know the itch is there in all our hands. If our funds are not doing well, there is an itch, because you see a show and you believe that there is some fund which is doing well. You believe that, hey, let me try and get out of this fund and get into this fund, because a lot of people say that it's good to cut your losses at a good time. So is there a cost associated with it? Does history teach us anything? We'll also try and talk about the latest AMFI data, of course, that came out on Wednesday, and are there some things to monitor as a result of that? Part 3, we'll talk about a large AMC which has recently undergone or gotten re-christened, and does it have a bearing on how investors and others view that? Does it have a bearing on funds? And somebody who's in the hot seat to try and answer some of those is Gaurav Rastogi, CEO at Kuvera, joins us right now on the show. Gaurav, good having you. Thanks for joining in.
Thanks.
It's your first time on the Mutual Fund Show, so good having you. Tell us something a little bit in a nutshell. Tell us about Kuvera. What does Kuvera do?
So we are online mutual fund investing platform. We have recently added digital gold to our portfolio as well. We were the first platform that went completely free. So it's a direct plan platform, but we don't charge anything from the customers. An investor, if they want to use our advisory modules, can then choose to pay for certain features. But otherwise, the platform is free for them to use.
Okay, so anybody wants to invest in mutual funds directly can come in through you. Something that I believe Paytm does, MobiKwik, etc. gives, your platform also does.
Exactly.
Okay.
Exactly. So there are about, I would say, 4 or 5 bigger players, and there is a bunch of smaller players in this space. And like it happens in every vertical in India, it gets hotly contested pretty soon.
Yeah.
So we are in the race. Yeah.
Okay. So you obviously launched, I think, in 2016 or thereabouts, and you've had prior experience in the financial space. And as a result of that, we've got this very interesting data, which is what we're going to talk about, and which is the theme that for the show today, which is the impact of frequently rebalancing your mutual fund portfolio. Now, what has history taught you? What does data taught you about this?
Right. So there's a lot of work that has been done, in the global sphere where data is more readily available, and there's a term that people use which is called the behavior gap. Right. Mm-hmm. So the idea here is that rebalancing in itself is not bad. Periodically, you need to make sure that your asset allocation is along the lines that it should be. So say you're 60% equity, 40% debt. Markets change and suddenly you are 80% equity, 20% debt, then you should rebalance. That's a good thing. Mm-hmm. What behavior gap specifically talks about is how people churn their data and how you look at the past few years of returns, and decide which funds to buy and which funds to sell. So effectively what happens is funds that have done well, a lot of AUM flows into them. And we have seen that. We have seen it at the fund level. We have seen it at the aggregate market level. When Nifty is doing well, a lot of money comes into equity. When Nifty is doing poorly, a lot of money goes out of equity. Precisely the opposite behavior.
What should happen?
That someone, if I had perfect hindsight, I would look at the data and I would say 2008 December is when you should put all your money into equity. That is precisely the point when, if you look at the flows data, is when the money is running away. And this mismatch where people are too dependent on the recent past years of returns to decide which asset class to go into creates a churn which also carries a negative returns on their portfolio. Mm-hmm. Right? So if you look at some of the international kind of studies that have been done, one is done in the US, the other one I believe is in the Netherlands. An average investor can lose up to 1.5% in returns by chasing in annual returns by chasing the recent past performance. So simply put, if your fund manager delivered a 15% CAGR or a 10% CAGR, right, then the investor, by trying to time the fund manager's returns, so they saw 3 years of good returns, they said, oh, get into this fund. They saw 3 years of bad returns, they said, get out of this fund, would only end up having, say, somewhere around 8.5% returns, right, on average. This is investors at an average, right? Mm. It's a big drag, that 1.5% or 1.56% to be exact, which is I think the US study which says that. That's a pretty big drag in terms of actual value lost, or how big your portfolio would have otherwise been if you had not behaved like that.
Yeah, those numbers tell you a story, don't they? I mean, yeah, at 12% return, it's that 10 lakh rupees would have been, whatever, in 5 years, 17 lakh rupees, otherwise it's 16 and a half. But the real number change, I believe, Gaurav, happens when you actually do what you're supposed to do, which is stay invested for a long period of time.
Of course, it's the nature of compounding, right? I mean, the nature of compounding is that it'll create that hockey stick effect, right? And if we go back to that data, and if we look at what happens at the 20-year horizon, right? So the difference in the portfolio at 5 years is only 7.27%. So you might think, big deal, yeah. But if you keep on doing this behavior for 20 years, you are 32% poorer than you would have otherwise been had you just said, thick or thin. Which is kind of a lot of, a lot of advisors and a lot of people, a lot of bloggers will also talk about. The real power of SIP actually is this discipline. Over and above anything else, because timing the market is so hard.
Yeah. Let's try and just a bit of a personal question out here. For somebody who's also been, I presume, having an equity or a debt background and not necessarily only a mutual fund investing background, does it become difficult? Because I know a lot of our viewers and a lot of people in general are not just pure mutual fund investors, they're also equity investors. And I think what they tend to do in individual stocks and get returns, hopefully, they try to mimic that in mutual funds as well. And I presume that is a recipe for, if not disaster, then low returns?
It's a very interesting point, actually. And it's actually a very, very interesting point, because when I was a prop trader, right, at Morgan Stanley, right, and if you are trading single name stocks, everyone will tell you about the importance of a stop loss or about cutting your losers, right? What is true at a single equity level or a single name level need not be true at a diversified portfolio level. A mutual fund is already a diversified portfolio. 25 stocks, 50 stocks, 100 stocks, right? It has much lower volatility. The ability for a mutual fund to take an impact and absorb it is much higher. Simple example. You're invested in a single name stock, bad news comes out, you could lose 80% of your equity. Fair enough. Happened in the recent past, has happened before, will happen again. It's the nature of the markets. For a mutual fund, if I own 50 stocks in a mutual fund, each stock is only 2%. Bad news comes out, that stock is down 90%, but impact on my overall portfolio is only 1.8%. Which you could very easily absorb, right?
Yes.
So I think that whole concept that in mutual fund, if you should cut your losses, it's a very different ball game when you're talking at a portfolio level versus when you're talking at a single name level.
Okay, getting back.
Sure.
So I think there is some data which also suggests that at times people tend to make this mistake of trying to time the market and getting out at exactly the wrong time, because the returns that come following a period of depression, not necessarily a year, maybe 18 months, maybe 6 months, but a period of depression. And again, you can probably only get it if you have perfect hindsight, but those returns are magnified simply because the base has started going down.
It's one of the hardest impulses to counter. So when as a professional trader, we used to talk about is that everyone has a breaking point. 10%, 20%, 30%, 40%, 50%. But at some point, the investor says, yeah, this pain is too much. Nifty is down 60%. Your rational brain, all the long-term studies you're seeing are telling you that this is probably the best time to invest everything into equity. Right? I'm talking about the 2008 scenario. But at that time, you've just taken too much pain. For you, it's almost like either that, you know what, let's just stop it and I'll fight another day, or some people think along the lines, maybe I get out now and I can then enter when it's much lower. So what happens is you get out now, but that get back in much lower is a much harder trigger to pull. A falling market, and you have lived through a few of them, I have lived through a few of them, they're scary.
It is.
And we can tell people what has happened historically. We can educate them a lot about, this behavior yields this return, this behavior yields this return. But every individual has to go through that journey and learn it for themselves on their own. Advisor can help you. Someone like something like our platform can help you. We can show you all the relevant data. But you have to go through that journey and say, you know what, I'm not going to sell out. Or even better, I'm going to add now. It's something we say pretty much all the time. If at 12,000 Nifty, starting a SIP was a good idea, how can it be a bad idea at 10,800? How can it be a bad idea at 10,000? At 12,000, you were willing to buy something, but at 8,000, suddenly it's untouchable.
Yeah, I think the feeling that comes in, and a lot of people say this, that yes, I know it is at 10,800, but I believe, due to whatever I've heard or otherwise, that the Nifty is on its way to 10,000 or even lower, and therefore I will start my SIP then. I'll time the market. Precisely what you're trying to say causes a loss of 1.56%.
Exactly, which is the other example, right? That I'm going to sell now, but I'm going to enter later. Sell now is done. The enter later, because when Nifty actually goes to 10,000, then your views have also shifted.
Sure.
Now you think 9,200 is the light level. Nifty comes to 9,200, again you're validated, but your views have again shifted. Now you think, yeah, 8,400 is better. So both cases happen. And effectively what happens is you don't deploy the capital at the right time. A lot of fund flows data show that. A lot of fund flows data into equities show that. And that causes that difference of 1.56% per annum in investor returns. It's pretty significant, right? If you think about it.
Pretty significant. But the other interesting bit is, and I was intrigued by this data, but you pull it off, of course, that maybe, just maybe, a way to counter cyclicality or maybe even enhance returns would be not through having a one-trick pony, which is having a set of mutual fund investments, whether it's debt or equity, but maybe a combined portfolio of various instruments or a couple of things, including gold and equity, might actually give you better returns. I want you to dwell a bit on this simply because almost every single advice that comes in across platforms, I think not just on the mutual fund show on BloombergQuint, speaks about this possible right point that if you are indeed investing for longer than 7, 8 years, 10 years, then you can choose to invest only in equity funds because history has shown that they have delivered superior returns. Now, can you dwell a bit on this?
Sure. And you know, it might sound a bit surprising. Both your statements are true. Because there is an if in front of it. You said, if you can stay invested for 9 years, equity is a good investment. I will not deny that. 10 years, I will not deny that. 20 years, so longer the time frame, but right. When the market falls, you are no longer invested. And that's the problem. So what diversification does, so simply, the simple idea of diversification is actually you want a bunch of assets which each have a positive expected return, right? So for example, equity, your expectations could be 8%, 10%, 12%. For debt, it could be 6%, 8%. For gold, it could be anywhere from 8 to 9%. So the expected return is positive. You don't want to be investing in negative return assets. But the returns come in different time periods. So when one asset is performing, the other one is not performing, right? So the benefit of having a diversified portfolio is that the losses are not as sharp. So you are able to ride it out. That whole if, that if you are invested for, see, if you have that discipline, if you say that I'm going to start these 5 SIPs, choose the funds you want as long as they're well diversified, ballpark, everything is good, right? Just don't go for sector funds and some of those specialist funds. And if you have that fortitude to tell yourself 20 years, done, not going to touch it, right? I agree with you. Your expected returns will be higher, but returns are not something which are on a piece of paper. They have to be earned. They have to be lived through. And that living through when your equity portfolio is down 40, 50% is the hard part. That's when if you have some fixed income in your portfolio, right? Some liquid funds, some debt funds. That's the time when if you have gold in your portfolio, which is a very good hedge in, if you look at the 2000 to 2003 time period or the 2008 to 2010 time period, your losses are, instead of your portfolio being down 40, 50%, it's down 20, 25%. The probability that you are going to live through that downturn and not stop investing is much higher. So you're giving up something on absolute returns. You absolutely are, right? I mean, that is true for an equity debt portfolio also. when someone says 70% equity, 30% debt, a 70% equity, 30% debt portfolio over 10 years or over 15 years.
100% equity portfolio.
Right. So it's a similar concept. It's just that you want to keep on adding asset classes which are not correlated. So people have long talked about, there's something also called an all-weather portfolio that has real estate. So it's basically equity, debt, real estate, gold, right? Real estate these days in India, of course, doesn't get much love, right? But there was a time when real estate was performing and equity was not performing. That's a good diversifier. There are times when gold is outperforming and equity is not performing. That's a good diversifier, right? So that's the entire idea. But to your statement, if you can write it on a bond paper that you're not going to be selling your equity portfolio and you're going to be investing in SIPs for 20 years, you're right.
You're right. But I think the table is interesting also because, viewers, what stood out for me when I looked at this data is that, yes, you can argue that the returns for a Nifty 50 from 1990 monthly were about 15%, and for gold was just 10%. I think the max drawdown is the other important part, because as you can see, what Gaurav was trying to say, that the max drawdown on Nifty 50 has been to the tune of 55%. And if you have the stomach and the gumption to digest that fall and say that, okay, I'm not a seller, in fact, my SIP continues and I'm a buyer at these levels, then by all means the Nifty 50 portfolio might beat, but otherwise diversification might actually help you. And I believe gold's recent performance kind of puts the smile on the faces of people who've probably bought into gold funds, or maybe not gold funds, but gold ETFs, because those have done remarkably well in the recent past.
Right, and this happens in every period of equity turbulence, right? It's driven by global factors, it's driven by wars, it's driven by financial factors. It's a safe haven. It has been for centuries.
Yes.
It's a commodity, but it's also a currency in its own right. It's one of the few things which is accepted globally.
Yeah. And as much as people would want to argue against it, somehow it always comes up and comes up trumps. Right. The other interesting bit, Gaurav, is what's happened, and I think today's or Wednesday's AMFI data, Association of Mutual Funds data, which shows what the mutual funds have done, etc., is an interesting one, simply because while liquid funds saw massive outflow, and it's a quarter-end phenomenon, so the opposite will happen. But the month-on-month equity flows overall went down. And I thought two numbers stood out for me. One, that the data is showing that 28% downtick. But two, that the SIP numbers are still strong at northwards of 8,000 crores. What do you make of this data?
I think we have to kind of wait for a trend to develop. But if I have to take an early read, right? Like I've just looked at this data, it's just come out.
Yeah.
As you rightly said, month on month, the equity data is down 28%. So, I mean, you look at Twitter, you look at any kind of social indicator on how people are thinking about the markets. One thing is really clear: there is some fear. There has been some bad news flows about banks, about NBFCs. There is a lot of pain that has already been taken in certain parts of the equity markets, namely the small caps and the mid caps. So there is some level of fear that's already there, and some of this behavioral gap could be manifesting itself. I'm not 100% sure about this, because at one point we're seeing that the net inflow is down 28%, but we're also seeing that the SIP flow is fairly constant, right? So I think at some point when kind of like what we were talking about, the pain becomes too much, that SIP number will also probably start coming down. We have to wait and see how this trend develops. I would say that I'm pretty impressed that the SIP number is flat, right? The net inflow numbers, it's down 28%, but if I look at it, it's kind of around the same levels it was in May and June. So it's not something which is, I would say, too much off the charts, like I think exactly what that chart shows. If you draw a trend line there, I'm pretty sure the trend line will also already start showing a downward trend. And the behavior gap is something like that. I mean, we can talk about it, but it always manifests itself. Even in the US markets, even in the global markets where people claim that the financial literacy is very high, right? All of these studies have been done in those markets. And there as well, you see that at different levels of pain, people will either stop investing or actually take money out of the market.
Okay, but you would reckon that continuing the SIPs is a good idea at the current point of time, despite the fears that exist?
See, that's the whole, if you were invested for 10 years. That's the same if right now, and if you think that, 100% equity is how I want to go, you have to answer that if question as a yes every time.
Okay, fair call. The other thing that I wanted to understand from you is what's happened for a couple of fund houses, namely one in news of late is the erstwhile Reliance Nippon Asset Management, wherein now Nippon Life is essentially the majority owner and the name change happens. Now, a lot of chatter around this on social media, and which is why it becomes important, because there will be a number of people who are invested in these funds.
Fair enough.
Does this name change signify anything, one from an investor perspective, two from how people would view this in terms of other flows, etc., coming in and stability of funds, etc., because all of that matters too. If redemptions are high, a lot of people would believe that if redemptions are high, then I don't want to be the last one to redeem my fund, I want to be the first one to redeem the fund. And therefore, does this have the opposite effect? I mean, what do you make of this? Is it a landmark event of sorts?
I wouldn't say it's a landmark event of sorts, and I think the way the mutual fund industry is set up in India, there is a custodian that is in charge of your assets. So it's not like the mutual fund company has carte blanche that they can do whatever they want to do, right? So the money is safe, but yes, perception plays a very big role. Like, bank runs are a perception thing, right? Especially so in credit funds. Because in credit funds, you can have a scenario, less so in equity funds, then I'll come to why I made that distinction. In credit funds, there is a possibility that if there are redemption pressures, I'll sell what I can sell. And what can you sell are the good assets, good credits, exactly what you said. Equity, that problem is less. Maybe in the small cap, micro cap space, you might end up with a few lemons, but in credit, that's a real possibility, right? So in that sense, as a perception thing, right, it matters immensely, right? Like, you have one of the largest life insurance companies from Japan coming in, a huge vote of confidence to what Reliance has built over years as their asset management business, and also to the mutual fund industry in India, right? Is the timing a bit too correlated? Of course, I think, if you were in those shoes, you would probably also kind of say, let's get the name change out as quickly as possible. But in terms of, is this something that people should be very worried about? I don't think so. I think it's a positive development. I think it's a good thing that has happened. The name change is a positive event, in my opinion, at least. It brings in a pretty big, well-funded organization as a mutual fund owner in our country. So.
Okay, I have one last question,
sure.
Off syllabus, but still bringing it out.
No, definitely, yeah.
For a lot of people who nowadays look to invest direct, your platform gives you that option, and a lot of other people who do that. What's the best way for a person to do that? Let's say I'm not a very well-read person about mutual funds. I don't know everything about every mutual fund. But I want to go direct because I've seen enough shows which say that if you save that expense ratio of X% over a period of 15 years, it results in dramatic returns.
Fair enough.
Okay. Yeah. So I come to your site, or I go to any other site.
Fair enough.
How do I choose the fund? Because the common fallacy, and the reason I bring this up, viewers, is because a lot of people go out, sort it by the best performing funds in the recent 1 year, 2 year, 3 years, and then choose the fund, which now people know it's wrong. But then people don't know what's the right way to go about choosing the fund. What should people do? They do not want an advisor. They want to go direct, and they still don't have enough knowledge. Is there a right mix for all of this?
So we, starting from very early on, we have been a big proponent of index-led investing, right? So if you do goal planning on our site, we will tell you exactly the portfolio you should invest in, and 60% of it is invested in index funds, so the Nifty Next 50 fund and the Nifty 50 fund. So in effect, we say that it's a diversified portfolio, it's a bet on the country at large. Selecting a fund manager is probably as hard as selecting which equity will outperform, right? There are so many funds and there are so many fund managers, and they're all, and this is not a testament against fund managers, they're all very smart people, but they're competing against each other. It's a very tough market out there. I mean, you know that, right? Like 40 plus AMCs. So we think for an early investor, index is a great place to start. Get some sense of not what risk looks on paper, what risk feels like when you go through a downturn. When you don't make money for 1 year and you're going to send an email to someone, 1 year I have not made any money, FD would have been better. That talks more about your risk appetite and how you think about risk. and you have to live through that. So index funds is a very good place to start. It takes away a lot of these kind of questions or a lot of these issues out, and purely focuses on, can you be invested for the long term?
Okay. So if you are indeed doing index or other direct investing, maybe go onto the sites and try and look at index funds. And once you've got the feel, maybe try and read up on some of the funds and then try and choose the fund on its merit, not on the basis of what the fund has done over the last 1 year. Maybe it's a good idea in select funds, but I think it's more a throw of dart as opposed to really having some science behind that. But choose a fund which has done well over the last 12 months and it'll give you good returns over the course of the next few years. We've said this a number of times on the mutual fund show, and we say it again because people keep on committing that mistake. But Gaurav, it was great having you today. Thank you so much for joining in on the mutual fund show.
Same here. Pleasure being here. Thanks.
And viewers, thanks for tuning into this leg of the mutual fund show. Stay tuned to BloombergQuint.